When I'm doing retirement income planning for my clients, one of the key things that we look at is how much tax are they going to pay on their retirement income? And can we plan for making distributions in a way that will minimize their tax over their lifetime? This is a very important thing to consider. Um, what happens is you go from working and having this high salary that you're paying income tax on to being retired, and suddenly your tax bracket is much lower, and that's a great feeling, but it can be very deceiving because at some point in time in the future, you're going to have to start taking those required minimum distributions. And the required minimum distributions can actually push you into an even higher tax bracket than you had when you were working. So this is something to be aware of. And a good place to start is thinking about the different ways that money is taxed when it comes out. You know, a good tax plan is an essential part of your overall retirement plan. It needs to tie in with all the other pieces. And having a good understanding of how money is taxed is where you need to start. So one of the main buckets that you save to is the taxable bucket. This is your savings account or a brokerage account. This is a bucket where you're taxed as you go. You don't get any benefit for saving into this bucket. You put money in your savings account or in your joint brokerage account, you don't get a tax deduction for that. That's already tax paid money. You may pay tax on some of that as you go. Interest that you earn on your savings account will be taxed each year, and you pay ordinary income tax on that. And then if you get dividends, that'll be taxed each year. Or if you sell something, you'll settle up on the gain, on the tax on that gain. So when you hit retirement, some of that bucket is already tax paid, and you won't pay tax on that again. Some of it could still be at a gain, and you would have to settle up on that if you wanted to utilize that particular account. Within that taxable bucket is what we call the tax-preferred. And this is really just pointing out that there are investments that give you a preferential tax treatment. If you invest in municipal bonds, you can have tax-exempt interest. Depends on where you live and which bonds you're buying, but you can have tax-exempt interest. If you invest in companies that pay dividends, then you could receive a preferential tax treatment on those dividends. If it's a U.S. company that you've held long enough for it to be a qualified dividend, then you'll pay a capital gains tax rate on the dividend, which is lower than ordinary income tax rates. Another bucket is the tax-free bucket. And all of the money that is in this bucket has the ability to come out tax-free, provided that you follow all the rules. And there can be some various rules around this that you need to be aware of. One of the accounts that's in this bucket would be your Roth IRA or Roth 401k. Money that goes into the Roth is not tax deductible. So you've already paid the tax on it when it goes into that Roth account. All of the growth then is tax deferred. You don't pay any tax on that growth, and it becomes tax free if you're at least 59 and a half and you've had that account for 5 or more years. All of the growth becomes tax-free and can come out to you in retirement with no tax. If you have life insurance, that's going to go to your family with no tax. And then the health savings account is the best account in this bucket because you actually get a tax deduction when you put money into a health savings account. So you can contribute to the health savings account, deduct that contribution from your taxes for this current year, allow that to grow with no taxes on the growth, and provided that you're pulling the money out to pay for qualified medical expenses, you pay no tax on that. So it becomes completely tax-free. So that is a very good account to maximize if you have the ability to do that. You have to have the right kind of health insurance to do that. The last bucket is your tax-deferred bucket. And this is your traditional IRA or traditional 401k, traditional 403b, those types of plans where you put money in and you get a tax deduction. You don't pay any tax on that contribution in the year that you're making the contribution. So that helps with your current taxes while you're working. It makes it very popular for everybody that's working and has a high income. It's a way to save on taxes. The money goes in, it grows. The growth is not taxed to you as you go along. But then when you want to pull money out, all of it is taxed at ordinary income tax rates. So you got that tax benefit early on, but down the road, it's going to come out at ordinary income tax rates. Not only that, when you hit required minimum distribution age, you're going to have to take a minimum amount. Whether you want to or not, whether you need it or not, you're going to have to take that required minimum distribution. If you're born before 1960, then the age is currently age 73 as your start date. And if you're born 1960 or later, then the age is 75. And when you hit that age, you're going to have to start taking some out. Those are mandated amounts. And as I showed on the chart, the amount of required minimum distribution can become quite big and push you into an even higher tax bracket that you had when you were working. And so you want to be aware of that and plan ahead for that. You want to think about, where is my money located? How will it be taxed when it comes out of that particular bucket? How can I blend the distributions to minimize my tax in each year as well as my tax over my lifetime? And should I move money from one bucket to another? Those are very key questions for you to be thinking about and addressing while you have the time to do it, so that you can make sure that you keep as much of your hard-earned money as possible and you pay the least amount in tax that you're required to pay. Makes absolute sense to do that. So look forward to talking to you next time, and have a good day.